headliner. He's Tom Lee. He works with the man you just saw on the television there, Mark Newton. But there's Tom from Fundstrat. So you're the chief strategist. I just heard from your chief technician who said the market's going to hit a new low. Are you guys on the same page or no?
Yeah. I mean, Mark and I talk constantly. We probably talked 3 times yesterday, and I heard his interview. I don't disagree that a lot of these groups are in existing downtrends, but most importantly, I think second half is still shaping up to be very strong. And I think there's a lot of catalysts in place. I think you guys discussed it for why stocks could reverse. And in fact, even yesterday, he talked about how if he saw near-term weakness, he would actually be buying that because that is really what he might think is the sort of near the final lows in place. And I think today's jobs report is a great example that as much as the headline looked like a really strong jobs number, I think the underlying details really support the idea that disinflation and the right parts of the economy are weakening. And that really means the Fed may not have to be as hawkish as the market's expecting.
Even so, though, they're still going to be aggressive. Now, they may not have to go as far into 2023 as the market initially thought it might. It's still going to be aggressive in the near term. Now, I'll give you credit. You have endured a lot of market body blows in the first half of the year, arguing that the second half was going to be good after a quote-unquote treacherous first half, which it obviously was. But is your second half case too rose-colored glasses looking through what is still going to be a choppy environment? Earnings are likely to be lower than we think, or at least that's the risk, and the Fed is going to be aggressive.
Scott, yes. I think there is risk to the E component to earnings, but I think what's far more important to equity prices and risk appetite is really the trajectory of inflation. The real massacre happened on June 10th when the May CPI report came out. Since then, as many of you guys have pointed out, commodity prices have rolled hard. Real estate prices have rolled hard. Rents are cooling. Even on the market side, the number of Fed hikes has dropped sharply. In fact, now the market believes the Fed peak is now March 2023 from late May. And in fact, if you look at inflation forecasts using swaps markets, inflation markets now see almost under 2% inflation monthly from August all the way through March. I mean, we're going to be looking at CPI prints potentially below 2% annualized for 6 months. I just don't see how that means the Fed has to be keeping their foot on the accelerator.
Well, I know, but here's what I don't understand. What makes you think that the drop in energy is sustainable? If you're going to argue that the economy is stronger than people are giving it credit for, isn't that going to keep demand up at a time when supply is still tight? I don't get it.
Yeah, Scott, it's a great point. Well, I think that what could be happening in the second half is the revelation that a lot of the inflation that people thought was sticky and structural really has 2 roots. One is a bullwhip effect because of the supply chain and the reopening economy. And the bullwhip effect is a known problem that causes double ordering, but then, of course, leads to a collapse on the other side. We're seeing that. And the second is that the premiums that people thought would be inflation because of the war are almost entirely reversing. You know, wheat is now lower than it was when the Russian-Ukraine war started, and gasoline is really within a couple of bad days of getting back to that $92, $93 range. Gasoline itself is still nearly 75 cents or $1 above where it was in February. So I think oil can stay here, but gasoline and things that are driving inflation could come down sharply. And I just think it means we do have some labor market driven inflation risk, but a lot of the things that people thought were sticky are actually turning out to be transitory.
I'm going to bring in Mr. Wonderful because he makes the case there's no reason to take down earnings at all, Kevin, right? I mean, you've heard the optimism in Tom Lee's voice and his outlook. By the way, his target's 5,100, which I know he thinks is a little bit of a stretch, but he's sticking with it, at least at this point. What do you got, Kev, for Tom Lee?
I agree with him. I'm a devotee of Tom Lee. I believe that what we're going to see happen, and particularly the short term, the back end of this year, is a surprise on earnings because so many analysts have already started to take down estimates both on top and bottom lines because they believe, and they're trying to, like everybody else, divine when this recession actually hits. I have that index that I get to use every Tuesday morning, just tear sheets on private companies' revenue and cash flow. I see nothing Nothing yet. And so every week goes by, you got to give me some recession. Bring it on. Where is it? And, you know, that's the problem. And so as we march towards the end of the year, maybe you could argue, and maybe Lee will do this, that maybe we see some softness in earnings in Q1, Q2, 2023. By then, the Fed has probably put on the brakes completely. And as far as you're concerned from an equity perspective, you get PE expansion again. This is not going to be what everybody thought. This is not going to be a hard landing. That's my opinion. Now, I have to make decisions every day like everybody else. I don't see hard landing. I see everybody trying to guesstimate what's going to happen. And I'm in the Tom Lee camp that says better upside for Q4. Just buy quality names. If you don't want to be speculative, don't buy companies that don't make money. There's plenty of companies that make money that have been crushed. I'm buying those.
Tom?
Yeah, I mean, I agree with Kevin. And many pundits have actually mentioned this. You know, nominal GDP is really going to drive a lot of the service sector EPS numbers. The manufacturers are going to be hurt by the bullwhip effect, and that's where you're going to have earnings weakness. But, I mean, tech is a great example of where earnings are probably going to hold up a lot better. Tech got destroyed earlier this year, and I think FANG is really one of the groups to watch because they're not too far away from doing an upside breakout.
So Jim Lebenthal has a question for you, and I'm going to give him the ball in a second and let him run with that. I just want to be clear, and I want our viewers to understand fully exactly where you're coming from. When I asked you if you agree with Newton at the top of the show, and you said you do, does that say that you agree with him that the S&P is going to put in a new low before it becomes a buyable low and the market recovers?
Scott, is that a question for me?
Yeah.
Yeah, Mark's reasoning, and I don't disagree, is that he thinks interest rates are going to make one move higher, and then that's going to compress PEs one last time, and that's where we get the downside target. Where I don't necessarily agree is I'm not sure interest rates are showing the motivation to move that much higher. It's not necessarily written in stone. Today's a good example. We got a hot jobs report. The 10-year is up, the yields are up, but they're not breaking out. And in fact, what's been pretty pinned is the 2-year. And, you know, the 2-year is a pretty good indicator where the Fed's going to be. If you look at market history, where the Fed funds are versus the 2-year, it would almost argue we're close to the end of the tightening cycle. And I'm not a Fed watcher, but I'm just observing since 1980, where we are in that spread historically is where the Fed is almost done with its tightening cycle.
I mean, I didn't grow up a Fed watcher either, but I'm a Fed watcher now. I mean, I know you watch the Fed a lot, right? Everybody does. How can you do what you do without watching the Fed? But I feel like you've taken me into a gray area here, though. It sounds to me, and I just want to be as specific as we possibly can. It sounds to me like you do not agree with Mark Newton that the S&P is going to hit a new low. Is that right?
Well, Scott,
come on, I want to pin you down. I want to pin you down. I mean, you know, the technician can have one view and you have a different view. It sounds to me like you're not fully on the same page with Mr. Newton.
Yeah, I guess that I'm going to give a two-part but a consistent answer. One is I think the structural lows are in, and so I want to buy any weakness. But on Mark's point, if there is a tactical rise in yields, which does hurt tech, which tech will pull us lower, we might see another downdraft. But even Mark wants to buy that weakness because he thinks we're going to make the year, you know, this low for this bear market sometime in July. So for your viewers, it's really how you're going to react to that low. And I would be buying that low, and I'd be buying tech here because, you know, Meta at 16 times earnings, with earnings visibility that's going to be improving, and, you know, with China recovering, these are things that are actually bullish for what I would say is a technology trade. So I hope that's a consistent answer.
No, it is. It is. I appreciate that. We're on the same page. I just want to make sure I fully understand it. And most importantly, I want to make sure my viewers do as well. Jim Lebenthal, question for Tom Lee.
Yeah, Tom, there's seemed to be a disconnect all year. Kevin was expressing it. I feel it, too, between what the market is saying and what the economy is saying. The market's saying recession is here right now. The economy, you look at it like, I don't see it. Part of the disconnect, and I think the biggest part, is consumer sentiment, which defies description for how bad it is. You talked about gasoline futures coming down. They're 20% off in a month, and that really has yet to show up at the pump, right? Because these are futures. The gasoline needs to be produced. It needs to be transported. The retailers need to reset their prices. Doesn't that set us up for some improvement in consumer sentiment, which, again, I think has been vital to why this year has been so ugly so far. Doesn't it set us up for a good second half?
Jim, absolutely. I mean, when it comes to how consumers see their situation and CPI, and our team had almost a 2-hour conference call with the researchers there. Food and gasoline are huge influences. Gasoline and food have really hurt people the last 2 years. But if gasoline goes to the February 20 levels, down another $1, and what we've heard from a lot of food distributors is they're sitting on piles of frozen proteins, foods. Nobody wants it because no one's really eating more. Food prices could be coming down. I think that there's going to be not only more money in people's pockets as these prices come down, it's going to be a real improvement in sentiment. And again, the Fed would just want to see people's expectations about inflation come down. If it's food and gasoline, you're going to see a dramatic drop in inflation expectations in the next 6 months.
Hey, Tom, how flexible are you? Are you able to stay with me past this break and we can continue the conversation on tech? Because you said a comment that you should buy tech now, and I want to get into that. But before we take the break, let me ask you that lastly for this block about Voyager Digital, which we know about this week going bust. They made an investment in you in Fundstrat, $6 million to, quote, be Fundstrat's exclusive U.S. partner and incorporate crypto research into the Voyager platform. Can you just expand on what the relationship was and what happens with that investment now, what the impact is, if any, on Fundstrat?
Yes. Foremost, Voyager's been a good business partner for us. We've liked working with the team. I don't have any comments about the circumstances that led to their bankruptcy. Earlier this year, they made a minority well under sub 10% investment in our company. And we viewed them as someone that we thought really we could expand as an operating partner. But I think that now that's just unknown. But I would say it's had no effect on our business. We don't manage capital. We don't have any loans to them or from them. So, it's just unfortunate what's happened.
You write down the value of the investment to zero at this point, or what happens from here?
Well, the investment that they made wasn't into Fundstrat. It was made to the existing their equity holders. So that has had no financial implications for Fundstrat as well.
Okay, I got you. Let's do this. Let's take that break. Let's come back. I do want to expand on